Welcome to Allianz Global Investors webinar series. Today our topic is the update on the US market. My name is Charles Ma and I am your host for this morning. The US Federal Reserve has just hiked their interest rate and has commenced their rate hiking cycle. I think it will be timely to host a webinar on this subject. The Fed don't hike rate very often. In fact, in the past 20 odd years that I've been working in this industry, I've only witnessed 3 Fed rate hike cycles. Today, we are happy to have Greg Myers, our senior economist at the Allianz Global Investors, to give us an update on the US market. At Allianz Global Investors, Greg is responsible for developing research with focus on the US macroeconomics, capital markets, monetary and fiscal policies. He is a spokesperson for the firms, conveying his high conviction ideas to both portfolio managers and clients. He is also a voting member of our global policy committees. On that note, Greg, the floor is yours.
In San Diego and this morning in Hong Kong and Singapore. So as Charles mentioned, the work that I do focuses primarily on the U.S. economy. I've been doing this type of work for 19 years now. I joined Allianz Global Investors through a predecessor firm here in San Diego called Nicholas Applegate Capital Management. I'm part of the economics and strategy team. My team is based in Frankfurt, where we're headquartered. So I work with them on a daily basis. I had a call actually about 12 hours ago with my team to discuss the Federal Reserve and the decision that we had yesterday. So as Charles mentioned, this is a big moment in monetary policy for the U.S. It's the first time that we've seen a rate hike in the U.S. since 2018. What I'm going to try and do over the next 20 minutes or so is outline what the Federal Reserve did, what they plan to do, and why. So what you have on screen is on the panel on the left, which you should be able to see, is the summary of economic projections from the Fed. The Federal Reserve produces an update to its economic projections every other meeting. So that's about every 3 months or so. The last update that we had was in December. So this is the first refresh of what they see happening since December. We just got the new data yesterday. So the panel on the left, the first takeaway here is that interest rates are going up. They just increased by 25 basis points yesterday. At the bottom of the panel in the blue, you can see the Fed funds rate, their forecasts for the Fed funds rate for 2022, 2023, and 2024. What you can see is the expected Fed funds rate at the end of this year, and these forecasts are all for the fourth quarter of each of the years. Their forecast for the end of the year is 1.9%. What that breaks down to is 7 25 basis point rate hikes in 2022. If you include the one that we had just yesterday, Wednesday, that means there's 6 more rate hikes coming. There are, as it happens to be, 6 more Federal Reserve meetings this year. So the expectation is that they'll raise interest rates by 25 basis points at each of the upcoming Fed meetings in 2022. They're expected to raise rates somewhat further next year in 2023 with another 3 to 4 rate hikes painted in for next year, and then they're expected to hold steady. You can see that these are it's a faster rate hiking cycle than what they had projected in December. That's the white row at the very bottom of that table. So they're looking to raise interest rates further. That's the first takeaway here. The second takeaway is that they're looking to increase interest rates above where they see the long run potential, the neutral rate being for the U.S. That's in the red box for longer run at the bottom right of that table of the forecast there. 2.4% is what they see the neutral rate being. We're not there right now, obviously. We're near zero. But the Federal Reserve expects to increase interest rates toward that direction, and then above neutral by the end of next year, and to hold there through the end of 2024. That's important because it means that they're moving from a more stimulative stance for the economy to a stance that's going to be reducing accommodation. They're taking stimulus out of the economy. They're not just going to be raising interest rates; they're going to be reducing the size of their balance sheet. Fed Chair Jerome Powell mentioned that yesterday. We should expect the beginning of balance sheet reduction to come with an announcement at the next Federal Reserve meeting, which is in May. And they'll probably start the process of reducing the balance sheet shortly thereafter, perhaps in June. So we have a Fed that is in the process of trying to normalize policy after the sharpest contraction in growth that we've had in modern history at the beginning of the pandemic. So at first glance, what you would expect to see if the Fed were to come out and say that they're going to be raising interest rates, that would be a challenge perhaps for risky assets. But if you look at what happened yesterday, risky assets performed very well. In fact, the stock market closed with gains in the range of 2 to 3% on the day that the Federal Reserve announced that they're going to be moving forward with interest rate hikes. So why might that be? Well, the first thing is the Fed is trying to address a challenge. And the challenge that they have is inflation is too hot. If you take a look at the consumer price index, for instance, it hit a 40-year low, 40-year high just last month. That's not normal. The Fed has a dual mandate from Congress. It comes directly from the government. They're supposed to have price stability and maximum employment. That's it. That's what the Fed is supposed to focus on. Price stability is inflation. Maximum employment, there's a few different definitions for it. So when you have inflation at a 40-year high, that means the Federal Reserve needs to take action to try to tamp down inflation. That's why they're moving forward with this policy stimulus reduction. Yet the Fed announced this change in policy yesterday, and again, what we saw was strong gains in the stock market. So why might that be? Well, if you take a closer look at the Fed's projections, there's a couple of other things that are important to note. The top row is real GDP growth. You can see that in blue, that's the March projections just from yesterday. In white, the second row down, that's the December projections. So the blue row is the one to look at here. For 2022, the Fed is projecting growth of 2.8%. That's going to be a slowdown from what we saw in 2021. Last year, the economy grew 5.4%. It was the strongest growth that we've had in the U.S. since 1984. Very strong year for growth. It's not going to get repeated. 2.8% is the expectation from the Fed for 2022. If you take a look at 2023, their projection is for 2.2% growth. Somewhat of a slowdown from this year, but still not bad. And then 2024, the projection is 2% growth. When I say not bad, what I'm talking about is in the top right corner of the table, where the long run projection, the neutral rate, the potential growth rate for the economy is about 1.8%. Okay, so the growth that we saw last year was exceptional. It's not going to get repeated. The growth that we're seeing this year at 2.8%, it's far above potential, okay, at 1.8%. The growth that we're looking at for 2023, according to the Fed's projections, at 2.2%, again, above potential, and the same is true for 2024. Importantly, the growth projections from the Fed incorporate the fact that they're reducing stimulus. These are the after the reduction in stimulus projections, okay? So even with the reduction in stimulus, they think that there's enough momentum in the economy to continue to grow very quickly above potential for the next 3 years. Additionally, if you take a look at the unemployment projections, that's the third row from the top, What you can see is that they're projecting unemployment at 3.5% for the end of this year, 3.5% at the end of next year, and 3.6% for the end of 2024. That's because it's a decline, first off, in the unemployment rate that we have right now. Unemployment last month was at 3.8%. It's also important in historical context. If you rewind prior to COVID, we were at 3.5% unemployment in the US in February of 2020. At the time, that was the lowest rate of unemployment that we've had in 50 years. Okay. The Fed is expecting that the unemployment rate is going to fall from 3.8% last month to another 50-year low by the end of this year and then hold there through the end of next year in an environment with above potential growth, even when you have the rate hikes that they have plotted out. So I think that if you listen to what Fed Chair Jerome Powell, his press conference, if you listen to the way that he conveyed why the Fed is moving forward with rate hikes and the fact that across the board, the policymakers at the FOMC believe that the economy is strong enough to handle the reduction in stimulus, that is why we saw some good returns out of equity markets yesterday. The chart on the right, what you have there is the Fed's two mandates from Congress plotted out. Okay, again, maximum employment, price stability, right? In orange, what you see there is the unemployment rate. Over the long run, the Fed thinks that unemployment should be in the range of about 4%. Again, last month we're at 3.8%, so we're tighter than the long run potential rate of unemployment in the U.S. According to Chair Powell, the labor market today is extraordinarily strong. There's a number of ways to look at it. If you look at job openings, they're near a record high. There's 1.7 job openings per unemployed worker right now. It's at an all-time high. If you're unemployed in the U.S. right now, you have your selection of opportunities. It's a very strong job market. So unemployment right now it's burning pretty hot. It's looking very strong. If you take a look at the blue line, that's core PCE inflation. Typically in the media and the financial news, what you'll hear is the CPI, Consumer Price Index. That's one of the most talked about measures of inflation in the U.S. The Fed likes to look at the PCE index, which is the Personal Consumption Expenditures Index. It's basically the same thing. There are a few differences, but I'm not going to dig into them today. What you're looking at, though, is the core PCE index. You can see that it was at 5.21% at the end of January, the highest in 40 years. From an inflation standpoint, the Fed needs to act. They've hit both elements of their mandate, maximum employment and price stability. They need to do something to prevent the economy from overheating. So that's why they're moving forward with rate hikes, reducing stimulus. And the way that Fed Chair Powell framed it, and if you've been following his press conferences at the end of each Fed meeting, he's very good at this. He's able to convey what he is doing, what the broader committee is doing in terms that make sense given the strength of the economy. And there are a lot of reasons to think that the economy is strong, not just because we had the best growth last year since 1984, but also if you take a look at the amount of money on, say, household balance sheets, we think that there's maybe $2.5 trillion that is sitting in forced excess savings accrued during the pandemic that should help to carry the economy, carry growth through at least the back half of next year. That's according to Goldman Sachs. So the Fed needs to do something about inflation. I think that, if you consider what the Fed is doing, I'm going to skip to the next slide here. I've got a bunch of material for you I prepared yesterday, and I'm not going to be able to touch on most of it. I'm just going to hit the most important parts, since I know that we're time sensitive, and I want to be able to answer questions for you as well. So why is the Fed doing what it's doing? Okay, so if you rewind back to, say, February 2020, prior to COVID, the economy was strong. Okay, it was the longest expansion that we had in U.S. history. Unemployment at a 50-year low. COVID comes up, and you have this downturn in the U.S. GDP contraction, about 35%, was the biggest contraction since World War II. Okay, so how did COVID affect the economy? There's four primary channels. You have those on screen right now. COVID is a different type of contraction than what we've seen during all the prior contractions. And I've been in the industry for a couple of decades now. Like my colleague Charles, who does a great job, by the way, and I love working with Charles Ma. Okay, so four different channels through which the pandemic impacted the economy. On the far left, demand effects. So aggregate demand, basics economics 101. COVID hits you, people quarantining, self-isolating, consumer and business demand collapsing, companies delaying investment projects. All of a sudden, you've got a 35% contraction in GDP, the biggest contraction in modern history. That's the demand effect. It was powerful at the beginning of the pandemic. Where are we today? Well, the economy was bigger than it was prior to COVID back in the first quarter of last year. If you take a look at, say, retail sales, we've been hitting record high levels of retail sales for the better part of 18 months now. Consumers are looking good, record highs retail sales. The economy is bigger than it was pre-COVID. The labor market is looking very strong. I'm going to say that the demand effects are resolved. If you look at the far right on screen, you've got the external effects. So trade, travel, and tourism. If you think about trade, we had a huge collapse in imports and exports at the beginning of COVID. Today, imports and exports, but particularly imports, are looking very strong, in part because there's so much spending power on behalf of consumers in the U.S. So imports are strong. Travel, if you look at TSA security throughput, at the security lines at U.S. airports, it was down about 99% versus pre-COVID levels early on in the pandemic in April and May of 2020. As of this 2 weeks ago, we were down 9%, a huge improvement there. And even an improvement just in 2022. We had the Omicron outbreak in the U.S. in January, and TSA security throughput was down 29%. 2 weeks ago, it was down 9%. It's not completely resolved, but I'm going to say that the external effects here are looking pretty good. I'm going to call them resolved anyway. Financial market effects. Beginning of the pandemic, financial market risk aversion widespread, equity markets collapsing, high yields, bond spreads spiking, cash demand, flight from risky countries. We had a pretty big hit early on in the pandemic, but where are we today? You take a look at credit spreads. They've come in materially, which indicates a very low risk of default among U.S. corporations. You take a look at the S&P 500. I'm not sure how many record highs that we hit last year. I think it was a dozen or so. It was a lot. I think that the last one was in January of this year. There's been some volatility recently with the geopolitical events, but the equity markets are looking pretty good. I'm going to say that the financial market effects are resolved as well. The one channel here that's not fully resolved is the supply side. So if you look down that column in red, reduced labor supply due to illness, taking care of children because the schools are closed, concerns around being sick or actually being sick, or your employers are shut down. That was bad early on in the pandemic. Where are we today? Well, there's still some shortages of labor. There was a study from the St. Louis Federal Reserve in August of last year that indicated about 3 million people retired early during the pandemic. Those 3 million people are no longer working. That's part of the reason that we've got a worker shortage in the U.S. right now. That's part of the reason the labor market is so strong. There's still a shortage of labor, a supply of labor. Goods and services. Early on in the pandemic, you couldn't go out to a restaurant if you wanted to. You couldn't go to a gym if you wanted to. The services were all shut down. You wanted to go to the grocery store and buy groceries, you couldn't because half the shelves were empty, right? Where are we today? Well, we're still looking at shortages of some goods because deliveries aren't coming through. We're still looking at shortages of some services. Restaurants aren't open as many hours as they would normally be because they can't staff correctly because of the labor shortage. So we're still looking at some supply side issues here. That's the overall story. You've got supply shortages of labor, goods, and services that are still in place, while you've got demand that has come roaring back with fiscal stimulus and excess savings. So there's this demand and supply imbalance. We heard Chair Powell talk about this yesterday, where he said, demand is higher than supply, and when that happens, prices go up. Well, that's the case, and you can see, I think, on this slide pretty well. So you've got the supply-demand imbalance. What that describes is a very strong economy that having a pressure build in prices with inflation going up. So what are the two themes to think about for 2022 and into 2023? I'm going to leave you with this slide, and we can shift to some questions. Again, I've got additional slides on the labor market. I can talk about the supply chain stuff. I can talk about the strength of consumers as well. But I wanted to leave you with a couple of key themes that we're watching for 2022 to put in your back pocket. Again, and this all feeds back into why the Fed is moving forward with its policy tightening. The first here is strong growth. Okay, so the chart on the right, what you have is the consensus expectations for GDP in not just the US, but several other countries as well. And what you can see is that consensus GDP expectations for 2022, they've been coming down. In aggregate, the sell side on Wall Street is thinking that growth in 2022 across most of the world won't be quite as strong today as they thought that it would be yesterday. That's okay. You know why? It's because we're still growing at a very strong pace, even with the reduction in forecasts. So if you take a look at the top left of the panel on the right, what you can see is 2022 and 2023 forecasts for the United States. 3.7% growth for 2022 and 2.5% growth for 2023. That's according to the sell side. That's higher than the Federal Reserve currently expects. Those forecasts will be coming down, okay? The chart, what it's showing, you can see in blue the trajectory, the evolution of the forecast for the U.S. A few months ago, people were expecting the economy to grow 4%. Now it's 3.7%. The Fed is saying 2.8% for 2022. What's important to keep in mind here, and what I tried to outline on that first slide, is that the potential growth rate of the U.S. is 1.8%. I don't know if you can see my cursor on screen or not, but if you take a look at the chart on screen, you can see the FOMC estimate of long-run potential growth, 1.8%. So we're a long way from that, even with the reduction in forecast that's coming. Okay, that's the first story. We still have very strong growth. It's in the pipeline. There's a lot of momentum that's in the economy. The second story here is inflation. The chart on the left is from the St. Louis Federal Reserve. What it looks at is the implied statistical probability of inflation at certain thresholds. The red area is the implied probability that you're going to have inflation above 2.5% out for the next 12 months. The key takeaway here is that this model from the St. Louis Fed has been showing a very strong base case that you're going to have high inflation above 2.5% since November of last year. I was using the same chart with my clients in Cartagena, Colombia, back in November on Thanksgiving. So, the likelihood that we're going to have high inflation was baked in. This is something that we've expected for some time, and it's something, frankly, we've been positioning for some time. The Fed is realizing that now in its forecast, and again, that's why they're moving forward with rate hikes.
Thank you. Let me see. We have a few questions. I think we can run through those, see how you can help clarify those for us. The first question we got is, how far are we away from resolving the supply side disruptions? You talk about the supply situation is one of the causes for the high inflation that we are seeing. How far are we resolving it?
So this is an important question, and it relates to a number of different things. So the first thing that I'll just draw back to is, if I can get my chart back on screen here, is this framework to work with, right? You've got this strong demand in the U.S., and a shortage of supply of goods, services, and labor, right? Um, I think that what you're looking at broadly, globally, is that we've had so much stimulus in the U.S. from a fiscal and a monetary standpoint, and so much forced savings in the U.S. due to the pandemic that household demand is excessive. It's very strong. We're drawing demand from other countries in. That's part of the reason that our imports are so strong right now. And that is resulting in a shortage of some goods. So, if you rewind to, say, the summer of 2021, the Fed was anticipating that the supply chain issues that we were running into would self-resolve over the course of the back half of 2021. They were wrong, and it didn't happen. There's a few different reasons for that. If you look at, say, the labor shortage, there's an acute shortage of truckers in the U.S. So even if you can get goods to ports, you have a hard time getting goods from the ports to the distribution centers onward to customers, businesses, and households. So there's this shortage of labor that's helping to create a shortage of goods. There's also external effects here as well. If you think back to August of last year, there was an outbreak of COVID in Ningbo that resulted in the shutdown of the Ningbo port facilities. Ningbo is the second largest port in China. So that resulted in some shortage of goods coming into the U.S. right before the holiday shopping season. It's part of the reason that we've seen a pileup of container ships off the west coast of U.S., at the ports of Long Beach and Los Angeles. And it's not just happening on the west coast of the U.S. We're seeing it at the ports of New Jersey and Savannah on the east coast as well. And as those log jams build up, they become harder to unwind. The containers are simply in the wrong places. So that's something that's still likely to persist, I think. If you think about the geopolitics that are currently in place, particularly what's going on in Eastern Europe right now, Russia and China are key producers of a number of commodities. You're talking about oil, natural gas, wheat, and something that took me by surprise just a couple of weeks ago to learn that Ukraine is actually, they produce, I believe, 90% of highly concentrated neon gas, which is a critical element that you need to produce semiconductors, which you need to produce cars. So if you don't have cars, then you're going to see more. You're going to see vehicle prices going up. And by the way, that's one of the reasons that we've seen a high inflation in the U.S. is because there's a shortage of vehicles in the U.S., which is, in part because of the shortage of vehicle components coming from other countries into the U.S. The supply chain stuff was supposed to self-resolve last year. It didn't. I think that it's going to be something that's likely to continue into the back half of this year at least.
Thank you. Thank you. Nice to know that. You're mentioning about inflation and is wage inflation, or from a macroeconomic perspective, is it a positive development?
And I think that it's one that the Federal Reserve missed early on. So raises, I would love a raise too. Let's be honest. Who wouldn't, right? And we're seeing raises in the U.S. fairly broadly. And part of the reason that we're seeing raises in the U.S. is because of the labor market shortage. So a couple of quick charts on that. On the left, what you have is the chart that I mentioned, the number of job openings per unemployed workers. The data here only goes back to 2001, but you can see we're at a record high. There's almost 2 jobs for every unemployed worker. If you want to find a job, plenty of them, okay? The chart on the right, what you're looking at is the percent of small businesses that say that they have positions that they are unable to fill. Roughly half of small businesses say that they've got work that can't be done because they can't find enough people to do it. So there's a shortage of labor in the U.S. One of the reasons that you're seeing that, and this is from the study from the St. Louis Fed that I mentioned, is because of all these excess retirees. in August, the St. Louis Federal Reserve put out this study, and the San Francisco Federal Reserve, by the way, did a similar study with similar conclusions, that there's been this huge wave of early retirees in the U.S., about 3 million of them. Why would people be retiring early? Well, for a few different reasons. First, if you're older, you've got your higher risk from COVID, right? Older workers generally have got more comorbidities that put them in a higher risk category with COVID. So you've got that to think about. You also, if you're an older worker, you've had more time to build up a nest egg. Particularly, my opinion here is biased, but if you've been working with Allianz Global Investors and you had invested, at the beginning of the pandemic, then you should have, a pretty good return, I think, on your investment. The same is true across most financial assets. So, retirees have done well with their financial assets. Real estate has done very well in the U.S. as well since the beginning of the pandemic. Home prices are up about 18% year over year as of last month. They never fell during the pandemic. So if you've got wealth in real estate or financial assets, maybe it's time to check out of the workforce. We've seen a lot of people do that. So that's part of the reason that you've got this worker shortage. That's part of the reason that you've got the labor tightness that you can see here. But for the Federal Reserve, that can be somewhat of an issue. Why is that? The chart on the right here looks at weekly wages, okay, on an annual basis. That's the blue line on the chart on the right. You can see weekly wages up 6.65% year over year. One of the strongest readings that we've seen in decades. You can also see in green the consumer price inflation index, consumer price index. And you can see that's up 7.87%. It's the highest print that we've had in 4 decades. Generally, when you have wages going up, what you see is consumer inflation going up as well, right? Because if my wages aren't increasing at the same pace as inflation, then I've got an argument to go to Allianz and say, hey guys, pay me more, right? The same is true for all of us. So if your wages aren't keeping up with inflation, then you've got an argument to get paid more. And that's something that's called wage push inflation. And that's a key thing that the Federal Reserve is being careful of right now, because the labor market is so tight. It's possible that you're going to see the labor market wage increases feed back into consumer inflation and become a self-propelling cycle. So that's where, if you listen to what Jerome Powell was saying at his press conference yesterday, he dug into this. Can the Federal Reserve move forward with rate hikes without causing unemployment to go higher? That was one of the questions that the media asked him during the press conference. And his response to that was, yes, we think that we can move forward with reduced accommodation without damaging the labor market because it has gotten so tight, because you have so many people right now that so many job openings right now. If you think about it, if you were to, you've got almost 11 million you've got more than 11 million job openings right now. If you reduce the number of job openings, that does not necessarily mean that you've got an unemployment rate that needs to go up. So you can take some of the heat off of the labor market, according to Jerome Powell, without damaging the labor market by raising unemployment. So there's a couple of different dimensions there. Raises are good. Everybody wants them. They can feed into inflation. The Fed is concerned about inflation. They need to raise interest rates. Maybe that means that wages don't go up quite as much as they are. But if my wage is going up faster than inflation, I'm still happy.
My question to you is, if Fed's hiking rate, would it damage the capital market instead of the equity market or the bond market?
This is an important question. So when you think about what the Fed does with rate hikes, what you generally would be worried about, first off, would be a flattening in the yield curve, right? So if you have the Federal Reserve increasing interest rates, that is going to raise the short-term interest rate in the U.S. The Fed moves the overnight interest rate, so that's going to go up. What you might not see is long-term interest rates moving up by the same amount, because the long end of the yield curve, the longer-term interest rates, those are affected more by market pricing, by investors, more so than the Fed, right? So when you have, say, low interest rates in Japan, low interest rates in Europe and China, what you can see is capital flows coming into the US to take advantage of relatively high long term interest rates in the US. That can help to cap long term interest rates in the US. That causes a flattening in the yield curve sometimes. We've seen that over the last few months. And I would expect that to happen more. That can raise concerns about the strength of the economy. Um, when you've had a yield curve inversion in the U.S. in the past, that has raised questions about whether the economy can grow as quickly as it has been. Those are legitimate questions. There's a couple of key things that I would have to keep in mind. Okay, so the first one, if you do see a yield curve inversion, and this is something that I don't think that we should be surprised by, if you do see a yield curve inversion, it does not necessarily mean that the U.S. economy needs to stop growing. Typically, if you are going to see the economy stop growing, it'll happen with about an 18 to 24-month lag after the curve goes into inversion, and we're not there yet. That would suggest that more of the economic risks would be taking place in, say, 2024, maybe late 2023, 2024. Every cycle is different. That's the first thing to keep in mind. There's generally a pretty long lag between how financial markets react to the bond markets react to the Fed's policy and how the economy reacts. The Fed is moving with these blunt tools that have a long lag time. So that's the first thing to keep in mind. The second thing to keep in mind is that even when the Federal Reserve is raising interest rates, equity markets can do very well. And that was one of the slides that I wanted to have in the presentation today. It's something that my team is working on right now. Believe it or not, there's a lot going on right now geopolitically. So we've got our hands in a number of different pies, as you say in the U.S. But there was another slide that I wanted to include for today that didn't make it into the deck. And what it does is it charts out the Fed funds rate. So that's their primary policy tool. It looks at the rate hiking cycles that we've had in the past, and it identifies what the equity returns, this S&P 500 returns, were during those rate hiking cycles. And across the majority of the cycles, what you saw were positive returns. So that's something to keep in mind as well. The change and shift in policy that we saw yesterday is important, but I think that the first indication that you can look at for how markets might react is the reaction that you saw yesterday with equities in an environment where you saw the Fed come out and say, not only are we raising interest rates, but we plan to raise interest rates a lot more than we told you in December. We're going to raise interest rates above the neutral rate, above 2.4%. That's the neutral rate. We're going to unwind the size of our balance sheet, and you saw equity markets rally, right? So keep that in mind. There's generally a pretty good long lag between what the Fed does and what it means for the economy. And during that time, you can see some very interesting returns, very positive returns in risky assets, like we saw yesterday.
Great. Again, thank you very much for your time.
Allianz Global Investors.